the IPO, to a large extent is like a wedding. It's basically an event. The size of the small and mid-cap funds has become very large. The largest small mid-cap fund currently is 70,000 crores.
Now, I want to know what is from your perspective, which IPOs are very good with respect to the sectors of the future?
Like banks is like singularly the largest, financials is the largest. Whether it's boring or not boring doesn't matter anymore because they have to come to market every 2-3 years to grow their book. Other financial type infrastructure, they have to keep building their net worth so that they can keep bidding for projects and growing.
Most IPOs we see, huge allocation is already given to them before they even come out of the market. Do you think there's a fight happening for allocation?
India is unique in a sense as compared to many other countries. In the institutional bucket, there was no discretion earlier. You could just put a bid and then get proportional. They actually carved out 60% of that. That is where there is a fight.
Now, for a retail investor, what would be that one thing that you would tell me, Shashank, you should look at this for every IPO? That should be the deciding factor.
Well, look, unfortunately, I can come with one because there will be a checklist, I think, of things to do. The first is
Welcome to today's episode of Make Money Matter. I am your host Shashank Goduppa, and with me I have Unmesh Sharma, who heads institutional equities from HDFC Securities. Now today we're going to dive into the world of IPOs. Now IPO is something that everyone is talking about in the industry, whether it's you trying to get in for listing gains or you trying to analyze whether it is a good company or a bad company. But the world of IPO has got the highest hype in the market right now, because most of the time you are applying to the IPO, you are getting frustrated because there is no allotment happening at all, but you still feel that you will get that one chance to apply in that one IPO that will make you very rich. But have you ever wondered what really happens behind the scenes? How do institutional players get allocation before the IPO is even out? How do they get a better price than all the retail investors? So in today's episode, we are going to open the world of IPOs and understand what really goes on behind the scenes. Now by the end of this episode, as a retail investor, you will have all the information while you're investing in the next IPO. So Unmesh, I want to talk about IPOs, right? Now, everyone in the market is talking about IPOs. Everyone is trying to get listing gains. All of that we know. But I want to start talking to you about something that people don't know, which is what happens behind the scene. So when a company decides to go for an IPO, they have to hire a banker for this. So you tell me, what is the process of this banker being assigned? What do they do? How are they incentivized? And what happens behind the scenes before an IPO even comes out?
Yeah, so look, the IPO, to a large extent is like a wedding. It's basically an event. But there is a lot of background work that goes into that, and then obviously the company is listed. So then you have to also go through, and satisfy whatever has to be done at that time. Now, if you look at the IPO process, the epicenter of that is the DRHP. That's the draft red herring prospectus, which is basically a dossier which has all the details about the company. Now, if you see broadly, what it does have is things about the company, then the statutory requirements like financials and so on and so forth, also what is happening in the industry and the risk factors. These are really the big ones, but there are multiple sections in there. As time has progressed, more and more disclosures have gotten into the DRHP. Now, why is that the epicenter, and how that affects everything that happens prior to that is that at the time a company decides to go public, they need an advisor who is going to tell them how to do this. Now, what are the two elements of that, right? The first element is the regulatory requirement of being public, which is where you need a merchant banker, you need a lawyer. And then there is the marketing bit, because you have to sell this to someone finally, right? So there is marketing and then there is regulatory. So for the regulator, what happens is that you work backwards from the DRHP. So just to give a simple example, if your accounts need to be audited by a peer-reviewed auditor, for example, and it has to be in a format of Ind AS, right, and not in GAAP, which unlisted companies can have some, there are certain provisions by which they don't have to disclose as much information, but at public listed companies have to do more. So what happens is that your advisors will sit with the auditors. They may even rework the board, because the board requirements are quite onerous for public limited companies, and guide the company through the process of satisfying the regulatory bits. Then there is the marketing bit. What is the story, right?
Yeah.
And what we do at our firm is that we also try to do a few checks with investors as to what they would like to see in the company. So, we get some feedback as to, what is the growth, each sector will have its own driving factors, what will be the margin outlook, what about ROEs and so on and so forth. And you build that into the story of the company in terms of growth and delivery of earnings. And what you do is that you start basically communicating as well as building the company into the IPO in the 2 years prior. And in that period, the entire legal and the merchant banker team will basically sit and put this. Then there is something called the kickoff, which is where all the merchant bankers who have been appointed by the company to take you public and the lawyers and all the counterparties like the auditor will sit together and for the next 2 to 3 months sit and make the DRHP. And then there is something called the filing of the DRHP, which is the day you tell public that we are now ready. Now there is a provision to do a confidential filing for new age companies, but that is a technicality. Broadly, you go to the regulator, which is SEBI, and you submit this document and you say, here are my disclosures. SEBI usually goes through 1 or 2 iterations of questions, and then assuming everything is in place, which your advisors would put in place, they will allow you to market this deal on the listing, on the day of the DRHP filing, and then around 70 to 90, maybe 100 days, they will give you an approval to go ahead and launch the trade.
So this is the process of when a company hires a banker or multiple bankers
Yeah.
till they file the DRHP. That is day 0 technically when
Yeah,
it
that's
actually
right.
starts.
Yeah, that's right.
So one more question I have, right? So when I was in investment banking as well, once the DRHP is filed, before the IPO even comes out, obviously there's a price discovery that happens, there's a valuation discovery that happens, because in DRHP they don't show the price band yet.
Yeah.
But when I was in the previous company, we had pre-IPO funds, we
Yeah.
had something called road shows. So
Yeah,
what
that's
are
right.
these basically before we even go out with an IPO?
Yeah. So look, what happens is in case of so there are let's take a case of a cement plant. Let's say if you have a cement company, you generally know how to price it because you have a lot of listed companies in cement space from very large to very small. You know how to compare. You know how investors look at it. But, for example, when Nykaa must have gone public, right? There is no real comparable of that, or when Zomato went public, or, there are certain deals we have done as well, where those companies do not have real. So what you do is that there are 2 or 3 reasons why you would do a pre-IPO. One is that there might be an investor in the company who wants to exit, and for some reason, because their fund life has ended, or because they need money in their personal capacity, or whatever, wants to sell. And you find someone who is willing to buy that company going into the IPO. So a pre-IPO fund is a specialized product for that.
So when they buy it in the pre-IPO, is it usually at a discount or is it at the IPO price that they fix for the future?
No, usually it's at a discount. That's for 2 reasons. One is because of the fact that the pre-IPO fund will be getting an unlisted security. Right? So there is no real market for that unless you do it, across the counter trade. So it's not like you can sell it in the market unless the company actually goes public. So there's a risk element to that. The other is there is a time element, right? Because at the time you do the pre-IPO versus when the company goes public, the amount of information available and how other investors are looking at it, etc., lot more information is available. So there has to be a discount for that. So to a large extent, there is some kind of discount. You can say that it's like a private equity kind of hurdle rate of 15-20% annualized.
Like a secondary, basically, like how it happens in companies.
Yeah. So you do tend to get it at a discount. Not everyone does. The other is what happens is that this is the interesting one because you can do the pre-IPO at 2 different parts. One, you can do it before the DRHP has been filed, where the information available is very close to zero because everything is across the counter from the company to you. When the DRHP is filed, the amount of risk actually reduces because the DRHP is very, very comprehensive. A lot of information is in there. So for you to do your due diligence on an unlisted company, actually it's a bit easier. So your discount also narrows as a result of that. If you do the pre-IPO after the DRHP is filed, your discount tends to narrow. And that is where a lot of in fact, now mutual funds have been able to participate. Now what happens is that if it's a very interesting company, and, in an IPO situation, you are competing with a lot of people to be able to get allocation, and we'll talk about that separately. But if you can do a pre-IPO, you can actually anchor the amount of money that you can get. So you may even do it at parity to the IPO price. It's not necessarily then at a discount because it's in the interest of the fund to then buy that. So there have been cases, like that as well, where someone may say that I don't really need to do it at a discount. I may just go ahead and do this.
So this is a very weird question, right? Do funds and fund managers who invest in these pre-IPOs or road shows, or you can also call it anchor investors, right?
Yeah.
Because most IPOs we see huge allocation is already given to them before they even come out to the market. Is there FOMO investing happening there as well? Because there is, as you said, there are so many people vying for the same thing. Everyone has an infrastructure fund, sectoral fund, thematic fund, and they have to deploy. So do you think there's a
what do you call that, fight happening for allocation, as you said?
Yeah, so look, it depends on the quality of the paper. Now, look, India is unique in a sense as compared to many other countries, including the US, that there are two differences. Okay, one is the banker who has been appointed on the trade is not underwriting the trade. In the US, what happens is that if you are trying to sell a $100 million IPO, and if only 50 sells, then they take the rest 50 and sell it in the market. In India, that doesn't happen. You create the book and you go to market. The banker actually never takes the paper on our own books. We never do that. Now, what that means is that every banker has to look for funds to sell before they can go. Now, what happens as a result of this in the United States, for example, is that you have full discretion on who you want to give the paper off to. In India, what happened was that that over a period of time, they found that I think there is the regulator thinks there is a risk that it will get cornered. And so what they've done is they've created these buckets. So the institutional bucket is half, 35% for retail. And there are various rules around that, but this is broadly how 80-90% of the IPOs are done. And then there is 10% for ultra HNIs, ultra HNIs. In the institutional bucket, there was no discretion earlier. You could just put a bid and then get proportional. They actually carved out 60% of that, basically 30% of the entire issue for discretionary allocation. That is where there is a fight, because for everything else, it's proportional. It depends on the size of the bid you put. So, in retail, as you know, that if there is 100 crores available for sale and if 1,000 crores come in, everyone gets 1/10, broadly. Yeah, simplistically, I'm putting it. And in the case of the anchor, that's not how it works. You actually the issuer can decide with the advice of the bankers as to whom to give it to.
So everyone gets an allotment.
Everyone gets an allotment.
Unlike the retail guys who don't get it.
No. But then a lot of investors don't get allotment at all. Okay. So institutions, not everyone will get allotment. It depends on the comfort of the issuer who is then working in conjunction with the bankers.
Okay, good to know that it's not just retail investors.
No. FOMO happens everywhere, I guess.
Now, one more question I have, right? So, India investors right now with IPOs, I think almost 80-90% of them, if I had to generalize, do it for listing gains, right?
Okay.
Nobody thinks about very long term. They buy a very good company, get 50, 60, 70% listing gains, sell it and go. Now, that is retail investors. Instant buying, 7 days, and then next you sell. Now, when it comes to institutions, they have a lock-in period, right? But usually institutions invest for a very long period of time because they have so much AUM, funds. And why do they exit in 30 days, right? Why are they doing listing gains after 30 days? Is it common or is it some new thing that has started in the market?
No. So let's take a step back. This is slightly more complicated. Now, inherently, fundamentally, given where the demographics of the nation and the shape of the financial institutions are, financial inclusion is, or participation in markets is, insurance companies and mutual funds, who are the two dominant domestics, are going to always get inflows just because of the young population and the way in which, numbers have just gone left, bottom, right, top on all kinds of participation in market. So they naturally are tuned to being long-term investors because you are only going to get inflows. You are not long-term investor usually because you have to sell and go somewhere, but there is no redemption really happening on an aggregate level. So they are long-term investors by inherent nature. And also in India, the liquidity is trapped in India. See, India does not have capital. A capital account convertibility is very low, which means a mutual fund investor putting money in a mutual fund, or for that matter in markets, knows that almost nothing can leave the country. So what happens is that you are even more kind of entrenched into the Indian economy.
So money is flowing inside the economy.
Yeah, it will just stay inside the economy. So if you have 10,000 crores of inflow in mutual fund, 10,000 crores will get deployed. If it's 20 will get deployed. And all in India because it's really not leaving the country. So what happens is that by inherent nature, the mutual fund and the insurance industry at this stage of where the country is a long-term investor. Just because if you sell, what will you do with that money? You have to buy something else. However, fundamentally, and this is how I think everyone should look at stocks, is that at any point in time, your portfolio should not be a reflection of what happened yesterday. It should be a reflection of where you see it going from today. Now, let's say that I bought a stock at 100 in the IPO. I got an IPO allotment. Now, for an anchor investor, half of it is locked for 30 and then half is for 90. But more importantly, there's a lock-in. Now, on the day the lock-in opens, on that day, dispassionately, the fund manager should think about two things. One is that at this price, am I a buyer even now? Okay. And at that point in time, if the answer is no, because the price, let's say, has doubled, and you were comfortable with 50% higher, then technically it is an expensive stock, so you might sell. It has nothing to do with the trend. It may just be that, look, this doesn't make sense at this price. So you may sell at that price. The other could be, and this is something that we have seen a little bit more happening in the last few years, maybe last 2 or 3 years, is the fact that the size of the small and mid-cap funds has become very large.
Yes.
The largest small mid-cap fund currently is 70,000 crores, HDFC, that's our group. But even otherwise, if you look at Nippon's funds or HDFC and some of these SBI's funds, multi-cap funds, a lot of these fund houses, there are at least 15 funds which are more than 10,000 crores. Now, let's say you got 20 crore allocation in an anchor, and you get another 5 crores in the QIB portion. So you have a 25 crore position. And in a 10,000 crore fund, it may not make any sense for you to have it. So on that day, what happens is that just to ensure that you are not running like 200, 300 positions in your fund and you want to keep it concentrated to generate alpha, you may find that you have to take a very clinical bet as to what you want to back. And if it's expensive, then you sell. This is a little new. This used to not happen so much in the past. So these are the things which have led to that.
So you're telling me it's actually mathematical, because when the price goes up, the P ratios that the fund manager would have calculated with his risk profile and risk margins would have gone off the roof.
Yeah.
With the new result, new earnings, if it comes in the next 30 days, he has a benchmark to play with, or else it is overvalued according to his fund thesis and he would take an exit out of it.
Yeah.
Right. Okay. Very interesting.
But if that person thinks that, look, this is a temporary phenomenon, that if it's only slightly overvalued, but I love this company, I do know that even on the day of listing, when almost all the market cap, the free float comes back to market, which is what's happening, which is what you were talking about, the 80-90% of retail guys are actually selling, you will find that funds are buying.
Can you give me an example that you might have seen in the recent, maybe 1, 2, 3 years, a new IPO came out, people went gung-ho, fund managers would love to have taken more allocation?
I'll give you one example where it happened both ways, because there was this Bajaj Housing right now. Okay, fantastic company, well run, all of that. We know it comes from the house of Bajaj, and we know that, right? Fundamentally, it was very sound. And then on the day of listing, if you see that finally when the stock went up so much, all the retail came to sell. Now, if retail is selling, someone has to buy, right? That's the market. And a lot of the fund managers, even at that elevated price, had a long-term view to buy and were absorbing all of this liquidity, right? So they increased their position. So let's say, the counter example of what I was saying, if you have a 10,000 crore fund, and to make sense in the fund, you need a 50 crore position. And if you have 25 crores, then you can also buy 25, right? You don't need to sell 25. So if they saw the liquidity is available at a price they are still comfortable with, they actually purchased all that. This actually happened. Now what happened was the stock went up further. And then on the 30th day, you found that for certain people, it just didn't make sense to do that anymore at that price. So they came and offloaded. But then, what happens is that after the first round of 30 days and then at 90 days, the stock finally kind of settles down completely. It's finally in the hands of people who want to own it. And so that's basically how people are thinking. Institutions are thinking.
And one last question on this, what happens behind the scenes wala part. If you talk about the book runners, which are the companies that actually do this IPO, how are they incentivized? Do they get shares? Do they get a fixed fee? Or do they get a performance fee on the IPO doing well or not? Because I want to understand who's incentivized where.
Yeah, no. So the major participants, major costs are basically the fees are to the lawyers, which is fixed, and to the BRLMs, the bankers. There is no shares here. Like, for example, if we are doing an IPO, we don't get shares in the company. I'm not convinced that we are even allowed to do that, I think regulatorily as well.
Can your anchor, can you buy from one of your mutual funds?
Yeah, so mutual fund and us have a very clear, strict, in fact, even physically we are separated from each other. So there's a Chinese wall. We don't talk to each other about whether it makes sense or not. For me, HDFC Mutual Fund is a client. So even in our case, we approach them on a complete arm's length basis. All the regulations of broker communications apply to us with HDFC the same way it would do with an SBI, for example. So in that case, there is no such thing. And if they take shares as anchor, that is up to them, and they are answerable to their unit holders, not to the bank or to HDFC Securities.
And is there a performance bonus?
So that is there for the bankers, where I would say broadly, while there are different structures and different deals, it's generally half the fee is fixed if the IPO goes through, and the rest is divided between the bankers on the ability of who has been able to garner how much. So like a performance bonus.
Wow.
Yeah, that's a tough one.
Wow. Okay. Wonderful. So I think this was a very good insight into, obviously, I wanted to understand what happens behind the scenes. So now I know. Let's come on the other side of the picture, now where the retail investors are there. Now I want to know what is from your perspective or from the fund manager's perspective as well, which IPOs are very good with respect to the sectors of the future. Because right now what is happening in this space, everyone is an AI company, everyone is a data center, semiconductor, when they have nothing to do with this, right? So what sectors are you very excited about? Like I know Bajaj Housing Finance, everyone was very excited. Similarly, what are some sectors that you guys keep a close eye on?
See, there are actually, I think there are two things. One is, while in general, I would like to say that the new age sectors look good. Okay, the way in which I think investors should look at IPOs and which is how it will get driven, I think, is the fact that one is that there are certain sectors which are naturally attuned to raising capital. So their job is to deploy capital. Okay?
Like banking?
Like banks is like singularly the largest, financials is the largest, right? Whether it's boring or not boring doesn't matter anymore because they have to come to market every 2-3 years to grow their book. So that's one. Other financial type, like real estate, for example, these are company infrastructure. They have to keep building their net worth so that they can keep bidding for projects and growing. So these are companies which will invariably come to market once they achieve a certain scale. So that remains exciting. It may be easy to understand because there are other peers who are listed. But then there are the new age sectors. Now, there is one very big additional factor which is driving. All the new age sector companies are mostly now owned by private equity.
The tech sector, like your Zomato and Nykaa and all of
Swiggy
these.
is coming now.
Swiggy is coming now, yeah.
So, you have the largest IPO was Hyundai, which is old school, right? Proper automaker, Indian operation of an automaker. While Swiggy is like new age, right? It's like a Zomato equivalent, or a competitor. So what is happening is that unlike, let's say, 10 years ago, where you used to also have a justification as to why you're going public. In this case, there is a private equity whose fund life may be coming to an end. So in that case, anyway, they have to come to market. So this may be one of the exit mechanisms, or they sell to another private equity. So there is a lot of that. So I think the nature of the paper will be in the next 3 years, maybe, or 5 years even, will be a lot of private equity exits and a lot of capital hungry businesses who will come to market for IPOs and QIPs. I think that's probably how it will go. And look, paper is paper. I don't think there is much to decide about what is more exciting or less, because finally it has to be at the right price.
Yeah.
If something's very exciting, but if you're going to price it at 100 times earnings, you're not buying, right? So it has a lot to do with the individual quality.
Now, for a retail investor, what would be that one thing that you would tell me, Shashank, you should look at this for every IPO, and that should be the deciding factor? I know price valuation is all there, important, but in the retail circle, we talk about, if it's too much OFS, we don't want to invest. Maybe it's not the right way to look at it, but we do look at big OFS means, it might not be good for the company. But is there something that I should be looking at? That is important?
Look, unfortunately, I can come with one, because there will be a checklist, I think, of things to do. The first is, look, I think what happens is that one of the, if I may call, issues with this entire process is the fact that DRHP does not have any projections. I think that is singularly the biggest, if I may call, issue for someone to assess the company. So nobody really credible has put out an estimate on this. So you have certain brokers who do that, but that is the one. So first is the investors need to have a clear view. See, you do have access to the management because you have they come on, there is a press conference and the media, and there is the analyst meet, which you can attend as a retail investor as well. Physically, it is there, it comes in the newspaper as well, that you can do that and listen to what it is and try and make some projections to see whether it makes sense or not. And then compare it to their peers. So
Listed
again,
peers.
so going back to my cement analogy, if something's at a discount to the peers and you think that is a relevant peer, then why not? That's actually how you should do it. If you want to go really deep, then you actually do the cash flow analysis by projecting. I think that's a bit much for retail. I really don't think that. The one thing that they should definitely look at is read the risk section. Usually, obvious risks are included. I have not seen many cases where you got caught by surprise because, the lawyers and the regulator make you put everything in there now, including cases against whatever.
But that's usually generic.
It's generic, but there is enough in there. It's a little bit of hard work. I think it's a case where putting too much has become a deterrent, but it's better than having nothing. So, in a sense, is on the wrong side, is on the right side of the balance in that sense. I think if you read the risk, you make the projection and you see where it is standing. I think also what happens is that which is your OFS versus primary. I don't think that is on a standalone basis such an issue. But it is still a flag that you should be keeping an eye on. If a company is capital hungry but not raising capital primary, then why wouldn't they be doing it? Because they have a nice opportunity to do it now. Is that because they were under too much pressure from sponsors to sell their stake rather than this? That is one. The other is that what I keep an eye on closely myself when I also look at, see, we are not bankers on every trade, so we also have to do the same exercise. The one thing that I look at is how much skin in the game is there for private equity after selling this. See, Indian promoters, family-owned businesses will tell you explicitly whether they are in the long run or not. Because they usually, it goes through the family, right? They are leaving it for the kids or something like that. But in case of private equity, what happens is that, let's say, Kim's Healthcare was basically a private equity promoted company. Now, if you sell 15% and you're left with 45, something like that. Not in this case, but I'm just saying. Then in that case, the question to ask then the intent of the private equity becomes important, which is not, the company may be very rock solid. But if you know that the private equity is now going to consistently keep dribbling their rest of their stake down, you know so much paper will hit the market that the stock may never finally be able to find price.
Yeah.
At the same point in time, you don't want them to be completely exiting, because when someone's completely exiting, they have no emotion led to it. So they will sell you at the highest possible price. And the one thing is Warren Buffett, the legendary investor, used to say that IPO is the most information asymmetry that you can get in the market, because the insider knows more than you. Yeah. So you have to be very wary that if an insider is selling everything they have, then should you be buying it at that price? I think these are broadly, the ones that I really keep an eye on.
Yeah, I think that is one of the biggest things that even I wanted to talk about. Understand today, right? Because I do feel that when the IPO comes, we only know what is the date that is launching, 7 days. We read the DRHP as much as we can. But I know that people behind the scenes know a lot more than us. They know what is the future plans even before us. So that's why when I see the anchor investors or book runners, I want to understand today what was their side of the story. How do they make money? Yeah. Why do they sell in 30 days and then 90 days? So I think we got a very good insight into all of that. So I think all of you guys got really good insight. And we spoke about some good sectors, how to remove the fluff, find out the real companies, and read the balance sheet, read the DRHPs and understand everything else. So again, thank you, Unmesh, for this amazing episode. And thank you guys as well. If you enjoyed this episode, don't forget to click on the like button and share this with your friends who would benefit from this amazing podcast series. Also, don't forget to click on the red subscribe button so that you can stay updated with more episodes coming up on the Make Money Matter podcast. You can also follow the show on Spotify, where we will update the latest episodes there as well. Now, one of the most important things about all these episodes is that we had experts from HDFC Securities giving you deep, valuable insight and knowledge. And all of this knowledge can be found in HDFC Securities reports as well, which is there in the description below. Now, these research reports are completely free and they offer you in-depth knowledge about the entire sector, which will also make you extremely financially smart. So follow us to get deep knowledge about each and every sector with experts. And don't forget to check out the research reports, because you don't need to go to 100 different places to check out reports, because we have all the amazing reports right here as well. And finally, the most important thing is that you need to make money matter. So stay tuned for more episodes and drop a comment below on what you think the next topic should be.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.